Good afternoon. Thank you again. This is Rhonda Hampton with HHM. We appreciate you joining our presentation on Tennessee tax credits and incentives. If you have need or would like to, you can look at my bio anytime on either LinkedIn or on the HHM website by just clicking my picture. And I am a longtime state tax specialist. So with that, let's get started talking about the universe of credits and incentives. First of all, our agenda today, we're just going to talk first of all about credits and incentives in general. Then we're going to talk about the difference between statutory and discretionary incentives. Then we'll start out with a discussion of statutory exemptions and tax credits, including corporate income tax credits. Then we'll talk about discretionary incentives. And of course, most of this will be focused on the state of Tennessee and what they offer. Then we'll go over some Georgia highlights. And then if time allows, we'll have a Q&A. If I'm unable to get to your question today, I promise you, you are not being ignored. Someone is taking down all the questions that come in, and I will get back with you, whether it's today or early next week. I will respond to those. So with that, let's get started. Let's get started with our credits and incentives overview. Of course, today we're focusing on incentives offered by the state of Tennessee, but whether it's the federal government, the state government, or local government, credits and incentives are offered for a reason, and these government agencies, basically, they want something in return for the gift they are giving you, so to speak. And the ultimate purpose behind it is to either grow the economy in a certain area or to create and sustain quality jobs. And so what these incentives might entail, they may want you to hire from specific targeted populations. For example, the federal WOTC credit, they want you to hire from long-term unemployed or persons who've been incarcerated or certain other groups. State and local governments want you to locate or expand operations within a jurisdiction. They want you to create new jobs or retain existing employee levels. They want you to invest in new property, plant, or equipment. Sometimes upskilling of employees is the goal. For example, new technologies are created all the time, and maybe you need to train employees on new technologies. So that would be a goal of certain incentives. They want you to invest in R&D activities. Sometimes there are incentives offered for investing in pollution control, sustainability, or renewable energy projects. And then there are, depending on the state, there's a myriad of different types of economic development incentives, such as related to film production or port activity. It just depends on the state that you're going into. There are different types of incentives offered. There are tax credits, tax exemptions, tax rebates, ad valorem tax exemptions. There are TIF programs and pilot programs, grants, the offer of financing, utility rate reductions, public infrastructure assistance, training cost reimbursements, potentially land donation. there's quite a large myriad of how these incentives can take place. Let's talk a minute about statutory incentives versus discretionary incentives. Statutory means that you have a right to that incentive. It's in the statute. If you meet the qualifications, for example, as a manufacturer, then you have a right to get your, excuse me, your manufacturing machinery free from payment of sales tax. So that is statutory. Discretionary incentives are different. They're typically negotiated or bargained for. The funds can come either from, sometimes there are statutory allotments. We'll discuss that later on in this program, an example of that. Some can come from first come, first served government funding, for example, a grant pool. And they say, you know, you may apply for this grant, but when the funding's gone, it's first come, first serve. Typically also discretionary incentives involve a contract or agreement, and typically there are compliance and reporting requirements. For example, pilot programs in the state of Tennessee, there are reporting requirements. We're going to go first into statutory exemptions and tax credits. Obviously today we can't discuss everything that's out there on the books. Time would not allow for that. We're going to try to hit some highlights to help you, make you aware of some of the basics and how you go about obtaining those. So we'll do the best that we can to get schooled in some of the more common statutory exemptions and tax credits. The first important note about statutory exemptions and credits is that even if an exemption or credit is statutory, there will still be administrative procedures with the Tennessee Department of Revenue. Also known as some paperwork or paper shuffling. The one that we're going to focus on mostly today, here's 3 different examples of sales tax exemption. We're going to talk about the manufacturing exemption for industrial machinery, and also manufacturers are entitled to a reduced rate on energy, fuel, and water at a rate of 0 to 1.5%, depending on how it's used. And they are also eligible for a reduced rate on gas, electricity, and other energy sources, again, depending on use. Let's talk about the exemption for manufacturing machinery. First of all, I put where the definition is located in the Tennessee Code. This definition matters. It matters because you have to understand it to understand whether or not you will qualify as a manufacturer. And it matters so that you understand what part of your business purchases will qualify for exemption. And I hate reading off slides, but I do want to cover a lot of what this says right here because it's very important. The exemption for manufacturing machinery covers machinery, apparatus, and equipment with associated parts, appurtenances, and accessories. That includes hydraulic fluids, lubricating oils, and greases necessary for the operation and maintenance of the machinery. It also includes repair parts, repair labor, and installation labor of the machinery. The machinery must be necessary to and primarily for the fabrication or processing of tangible personal property for resale and consumption off the premises. It also includes pollution control facilities. And then we're going to talk about this last section here, where the use of such machinery, equipment, or facilities is by one who engages in such fabrication or processing as one's principal business. That may not sound like an important sentence, but it's very important, and here's why. Let's say, for example, you have a business where you manufacture a certain type of specialty brick, and 30% of your business of your revenue stream comes from those specialty bricks that you sell. But 70% of your revenue stream comes from just standard bricks that you buy from other manufacturers and resell those. Well, in the eyes of the state, because you only manufacture 30% of what's going out the door there, you will not qualify as a manufacturer. And they do not do piecemeal manufacturers. It's the 51% rule, and it's been that way for quite some time. So, in other words, you have to make sure that more than 51% of what is going out the door at that location is indeed being fabricated and processed there and is leaving the premises for resale. Industrial machinery also includes machines used for generating, producing, and distributing utility services, electricity, steam, and treated or untreated water. And then it also includes equipment used in transporting raw materials from storage to the manufacturing process, and transporting finished goods from the end of the manufacturing process to storage. Now, that sentence that I just read is also very important for manufacturers, because that tells you the start and the end of the manufacturing process. For example, if you have a fork truck or a conveyor that is transporting raw materials from the storage, from a storage facility to the manufacturing line, that will qualify. Or a conveyor or a fork truck, for example, transporting finished goods from the end of the process to storage would be exempt. That's the last instance of manufacturing. An important note is that not everything in a manufacturing plant is exempt in the state of Tennessee. Taxable items that you really need to be on the lookout for would include things like company vehicles and corporate aircraft, logistics equipment that's strictly used in the warehouse, office equipment and supplies, break room equipment and supplies, hand tools and so forth. All of those things would be subject to sales tax, and the manufacturer would be expected to pay sales tax on those. The next question is, the exemption for manufacturing machinery, is this automatic because it's written into the statute, or do you have to apply? You definitely do have to apply, and you get in return what is called an industrial machinery permit. First of all, you have to register for sales tax purposes. Then you apply for the industrial machinery exemption, and I put the form number on there. These forms that I have on here today are readily available on the Tennessee Department of Revenue website. There are a few important notes here. Multiple manufacturing locations require separate registrations and separate industrial machinery exemptions for each location. And one of the reasons for that is because manufacturers are entitled to a reduced rate on utilities such as electricity and water, that can only be done on a location by location basis. So for example, if you have a manufacturing location in one place, that would be eligible for an industrial machinery permit, and then you have a retail store in another place, obviously the retail store cannot get those reduced rates on any sort of equipment or utilities. And so each location has to be separately registered. Another important thing is that if there are contractors involved in the purchase and or installation of manufacturing machinery, they must apply for industrial machinery exemption on a per job basis. The manufacturer's exemption does not automatically flow through to a contractor. Multiple contracts with the same manufacturer will require a separate machinery application for each contracted job. That can get a little bit onerous if you are a contractor and you do a lot of different jobs for the same manufacturer, but that has been their position for a long time. Contractors use the same form as manufacturers, and I believe there is a special checkbox on there for contractors. Let's also talk about the sales tax exemption for our R&D equipment. It's a very similar definition to what you find in the manufacturing machinery definition. However, it's important to know that you are not required to be a manufacturer in order to get R&D equipment exempt from sales tax. Here is a rule that explains that the ultimate goal of qualifying research and development must be one of the following. It must be a basic research in a scientific field of endeavor, advancing knowledge or technology in a scientific or technical field, the development of a new product, the improvement of an existing product, the development of new uses of an existing product, and the design and development of prototypes. Here is what is not research and development. It does not include ordinary testing and inspection of materials or products used for quality control, market research, efficiency surveys, consumer surveys, advertising and promotion, management studies, or research in connection with literary, historical, social science, psychology, or other non-technical activities. That type of, if there is equipment used in those, it does not qualify. It has to be scientific or technical. You do have to apply for this. You must first apply for a sales and use tax number, and then I have the form number that you have to use to get exemption for research and development equipment. Okay, let's talk about corporate income tax credits in Tennessee. First of all, there is an industrial machinery credit. Industrial machinery has the same definition as it does in the sales tax code, which I just read you a few minutes ago. The credit is 1% of the purchase price of industrial machinery purchased during the tax period covered by the return. It cannot exceed 50% of your Tennessee franchise and excise tax liability. The credit has a 15-year carry forward. Leased machinery also qualifies for the credit, but it must be new original use machinery to qualify. And next we're going to get into jobs tax credits. And let's just talk for a moment about just some general comments about jobs tax credits, whether you're looking at Georgia or Tennessee or other states. Projects in more economically distressed counties, the counties are rated by both Tennessee and Georgia each year, result in higher levels of incentives, both statutory and potentially discretionary. If you go on the Tennessee Department of Economic and Community Development website, they actually have listings of distressed counties in the state and also at-risk counties in the state. And also just a general comment, the greater the level of hiring and investment, of course, the greater the potential incentives, particularly when it comes to negotiated or discretionary incentives. One of the most, and arguably the most important incentive in the tax code is Tennessee's jobs tax credit. I guess this and the manufacturing machinery exemption from sales tax are probably two of the most used and two of the most important. This jobs tax credit is for capital investing and hiring in Tennessee. It will apply to both the franchise and excise tax. The amount of the per job credit depends on the county where the business is located. Jobs in certain counties may be eligible for an enhanced credit, and it cannot exceed 50% of the franchise excise tax liability, and it has a carry forward provision. First of all, required capital investment, except for convention and trade show, is $500,000, not a tremendously huge sum. So that is the definition of required capital investment for the basic jobs tax credit is $500,000 in Tennessee. A qualified job means a job that meets all of the following criteria. The job position is permanent rather than seasonal or part-time. The position provides employment in a qualified business enterprise for at least 12 consecutive months. The job must provide at least 37.5 hours per week. And yes, they are sticklers on that number. The job must provide minimum health care. You have to offer it. The person does not have to take it, but it does have to be available to them, and you do have to offer it. One thing, just a side note here, there are some additional rules in the code for adventure tourism. I did not tackle those in this presentation. And so a qualified business enterprise is an enterprise which has met the required capital investment necessary to permit the creation or expansion of manufacturing, warehousing and distribution, processing, R&D, computer services, call centers, headquarters facilities as defined, back office operations, convention or trade show facilities, again, as defined, or tourism-related businesses. So when you fill out a business plan and you submit it to the Tennessee Department of Revenue for review, you have to tell them what your investment period will be. And that's the period of time that you think that it will take you to get both the capital investment amount of $500,000 plus the minimum hiring level for the county. And we're going to see a chart on that in a minute. It cannot exceed 3 years from the effective date of the business plan. So here is a chart outlining the hiring requirements. In Tier 1 and Tier 2 counties, you can see it is a minimum of 25 hires during the three-year period. A Tier 3 county only has to get 20 hires during the 3-year period, and a Tier 4 county only has to get a minimum of 10 hires. Just to give you a couple of examples of the current tier map in Tennessee, for example, a Tier 1 would be Hamilton County or Knox County. An example of Tier 4 locally, Ray County and Meigs County are both Tier 4 counties. The important points to remember are you have a 3-year time frame to make the hiring and do the $500,000 minimum capital investment. You do not have to complete the jobs tax credit business plan in advance of the hiring or investment. You may file a business plan for periods that are outside the statute of limitations. However, how this works is if you do find out that you should have filed a business plan and the period is outside the statute, you get the carry forward. However, if you want a refund, if you want to amend returns due to the jobs tax credit and get refunds, the period must be within the statute of limitations. And I've got a little chart here. This is an example for a Tier 1 county. And let's say that they wanted to do a business plan for a three-year period, 2018, 19, and 20. Their hiring would be based on a base year of 2017. You can see that this Tier 1 county needs 25 hires in order to claim the credit. In 2018, they only have 5. In 2019, they have 10. And in 2020, they have 20. So in 2020, they finally get their, they exceed their 25 hire minimum. And actually they've got 35, but because their business plan covered the 3 years, they can take credit in 2020 for all 35 hires. Also important here is that they didn't meet their capital investment in 2018. They did meet it in 2019, but they hadn't met their hiring yet. And so in 2020, they had met both. You do have to meet both before you can take the credit, but do remember that you do get a nice carry forward on this. Another important thing is that it is net new hires. So for example, if you hire 30 people in a year, but you're in an industry with a lot of turnover and 25 people quit, you only have 5 net new hires. And so it's not based strictly on hiring, it's based on net new hiring. And here is another example of a Tier 1 county. They actually met the hiring and the capital investment in all 3 years. They have an option here. You do not have to do a 3-year business plan. They can do a business plan for each year separately and get these the jobs tax credit. Let's talk for a minute about discretionary incentives. And as we already said, these are incentives that typically, they're grant-based. They're typically negotiated or bargained for. There typically are very stringent hiring and capital investment requirements. And generally, these discretionary incentives have a clawback feature for failure to meet the requirements. And discretionary incentives may, and that means probably will, involve multiple state and local agencies, such as Economic and Community Development, the Department of Revenue, and Industrial Development Board. It all just depends on the type of incentive that you're looking at. The first thing we're going to talk about is Tennessee's Fast Track Job Training Assistance Program. This is through Tennessee Department of Economic and Community Development. And they give grants to assist new or expanding companies with funding to support the training of net new full-time employees. Funding for this is allocated in the state budget. So it is a state budget item. So hopefully, if you went after this, there would be some money there for it. This is a little bit different in that it is only for new jobs created. It is only forward-looking. It is not for already hired. There is a formal application process for the Fast Track Job Training Assistance, and retail and hospitality are excluded. There are some other training grants that are available through the Tennessee Department of Labor and Workforce Development. That money is provided through federal funding. Those grant pools may or may not be there at any given time. There's one called the Incumbent Worker Training Grant. That particular grant is for upskilling of employees. There are on-the-job training grants and also apprenticeship training grants. The one I'm going to talk about just a little bit is the Incumbent Worker Training Grant. And qualifying businesses have to be classified as a Tennessee for-profit. It has to have been in operation for at least a year. It has to have at least 5 full-time employees, current on all tax obligations, and the business must be a financially viable business, and it cannot appear on any federal suspension or disbarment list. For the Incumbent Worker Training Grant, costs that can qualify for reimbursement, instructors and trainers' salaries, curriculum development, textbooks and manuals, materials and supplies, and tuition expenses that have to meet a certain definition. Non-reimbursable costs are the trainees' wages. purchases of capital equipment, purchase of any item or service that can be used outside the training project, travel expenses, assessment and certification fees, language training generally, and or advertising or recruitment costs. Let's talk a little bit about the Tennessee's Fast Track Infrastructure Program. These are grants made to local government bodies for public infrastructure improvements, but they must be for specific infrastructure projects benefiting one or more companies committed to creating new jobs and making new capital investment. These type grants, again, they go to the local governments, but they do cover infrastructure such as rail, public roadways, airports, water, sewer, gas, and that type thing. Those grants do require local matching funds based on the community's ability to pay, and they require a payment in lieu of tax for at least 5 years on real property. There is also a thing called a Fast Track Economic Development Fund. This is to help companies offset costs when expanding or locating a business operation in Tennessee with reimbursable grants made to local governing bodies. I think you have to go through an industrial development board to get this particular one. It can offset the costs, including retrofitting, acquiring real property, relocation, and other expenditures that are not otherwise eligible under Fast Track Infrastructure that we just talked about, or the Job Training Assistance Program. This particular one is used in exceptional cases where the impact of the company on a given community is significant. I have been told that significant means a $40 million investment and 100 employees hired. So it is pretty significant. So if you're looking to expand or looking to go into a new area, and you go on the Tennessee websites and you want to look at what's available out there in specific areas or how the counties are rated, the Tennessee Department of Economic and Community Development, that is an excellent website. The state is divided into 9 regions. There is a regional director for each region, and there are also directors for specific international geographies. And I did put the web address on there for you. That is a very good website. Tennessee Department of Revenue, of course, processes industrial machinery and R&D exemption applications, jobs tax credit, business plans. They review jobs tax credit hiring and capital investment documentation, of course, amended returns, and so forth. So those are the different duties of each of those departments. Another starting place, if you are interested in expanding or moving to a new area, the local Chamber of Commerce may be helpful. It depends on where you're going. Some of the smaller, less populous counties in the state may not have a strong chamber, and you can always start with the Tennessee Department of Economic and Community Development. But I do know the chambers are always happy and willing to help. This next little section is just a brief FYI on a couple of special grant programs. Of course, this summer, Governor Lee announced the use of federal relief funds to assist Tennessee small businesses. That program went very well. Payment amounts were based on a business total gross sales and ranged between $2,500 and $30,000 per business. Eligible businesses were limited to those with gross sales of $10 million or less. This program did close September 30. $200 million was distributed to 28,000 businesses in Tennessee. 70% of those recipients had gross sales less than $500,000, and specific industries qualified with no application required. There was a new program called the Surge Program that was announced on September 7th. It was open to all businesses with less than 10 million in sales. It is an application-based program. 50 million was allocated to this grant program on a first come, first served basis. And it was for reimbursement for business interruption or direct expenses incurred through a certain period of time. And it is my understanding that they have had a ton of applications for that. Okay, additional points that we may want to talk about. Do other states have similar credits and incentives? Yes, they do. However, the type and the mechanics of how they work can vary very greatly. For example, what qualifies as manufacturing machinery even can vary somewhat from state to state. So you can't just make assumptions there. We're going to talk a little bit about Georgia. Georgia does exempt from sales and use tax, machinery and equipment for qualifying manufacturers, of course, repair and replacement parts, molds, dyes, and waxes, tooling, raw materials, of course, and packaging. Distribution centers investing a minimum of $5 million in a new or expanded facility are eligible for sales and use tax exemptions on machinery and equipment used to handle, move, or store tangible personal property. Georgia also has a jobs tax credit. It ranges, depending once again on the county, from $1,250 to $4,000 per year for 5 years for every new job created. The jobs must be in specific industry sectors such as manufacturing, warehousing, distribution, and logistics. And you can see, of course, the others there, or a headquarters of one of these industries. You must create a minimum number of jobs within a year. The number depends on your company's tier or special zone. To keep earning the credit for all 5 years, the jobs you create must be maintained for all of those years. Once your project qualifies, the clock starts ticking on a 5-year window. Each new job may earn job tax credits each year for 5 years. The value depends on where the new jobs are created. Counties with the highest level of economic distress are classified as Tier 1. They do it exactly the opposite of Tennessee. A Tier 1 in Tennessee is the lowest level. In Georgia, it's a Tier 1. Those are eligible for $4,000 per job per year for 5 years. New jobs in counties with less economic distress can earn lower credits, such as $1,250 per job. Georgia also has special zones, military zones, less developed census tracts, and Georgia opportunity zones. which is not the same thing as a federal opportunity zone. They have their own. In Georgia, jobs tax credits may be used to lower payroll withholding obligations if the job is created in a special zone or a tier 1 county. And here is just a chart to overview the different tiers. And of course, as with Tennessee, you can go on their website and look at the counties and see what qualifies where, and the credits and the carry forward. For example, a tier 1 county, which would be the more impoverished counties, you only have to have a minimum of 2 jobs, or a tier 2, 10 jobs. So Georgia has a really good and very popular jobs tax credit program. There are some qualifications. Each job must have a minimum 35-hour work week. They must offer health insurance benefits consistent with what is offered to existing employees, and they must pay more than the average wage of the county with the lowest average wage in the state, which as of June 2020 was $541 a week. If you want more information, Georgia has a really excellent brochure on all their various types of incentives. Of course, there is the address and phone number of the Georgia Department of Economic Development, and then there is the website location. Before you begin a big credits and incentives project, the thing you need to know is that, and this is in no way meant to discourage anyone from claiming what you are entitled to or what your business could get. However, many credits and incentives require heavy amounts of documentation and compliance. You do need to estimate the cost benefit before you get into it. If it's something which most of this does affect some type of tax return, tax returns are always subject to audit. Incentives, particularly discretionary incentives, are subject to increased public scrutiny. For example, if you go into a county and you get a lot of big property tax abatements and so forth, that is probably going to be on the news, although people may be very, very glad that you're there and that you're bringing jobs. Also, the thing that you need to know is that discretionary incentives will be subject to clawback if agreement terms are not met. And I do know they track this, and I do know that they enforce it. So anyway, I hope today's presentation has been helpful to you. There is my photo, my email address, and my direct line at work. Again, just contact me with any questions that you have, and I'll be happy to either answer it or find the answer for you. Thank you again for being present on today's program.